Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with thinkorswim. And today we're going to be talking about understanding and using the trade probability tools that are available on thinkorswim. I think it's a natural question when a trader has an idea for a trade. We're going to be using options for today, but when we have an idea for a trade, we ask ourselves, I wonder what the chances are this trade's going to make any money. What are the odds that it might just lose money, or what are the odds that it might just break even? Well, that's exactly what we're going to be exploring today. 6 tools that can help a trader calculate the odds of success or failure, even just breaking even on a trade. So a lot to cover, a lot of tools that are going to be new for some of you. Some are going to be familiar for some of you as well, but I think there's going to be something interesting for just about everybody. Before we dive into that, though, let me first of all say hello to everybody that's already chatting in out there in YouTube. Hello there, Jim and Ask a Coach, Life in the Fast Lane, Ricebird, Richard, Eva, Lawrence, Greg, Tony, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording, but be aware that you're invited to join us in the live webcast, which is a Wednesday webcast series. It kicks off every Wednesday, 2 Eastern time. Would love to have you here in the live stream audience. And as a treat here for our live stream audience members, Kevin Horner is going to be hanging out in the chats. He's going to be addressing any questions that I can't get to that come in during the flow of the presentation. Thanks for having my back there, Kevin. Kevin and I have been working together for years now, so great resource to have here. Kevin and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite Schwab presenters there. It's the best place to connect with us in between these live streams. So you can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. But let's get into this discussion of probabilities and probability-related tools. As we do, of course, we need to bear in mind the risks associated with investing. Risks are real, so bear this important information right there at top of mind. All corporate/issuer names and market data shown are for illustrative purposes only and are not a recommendation, offer to sell, or a solicitation of an offer to buy any security. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. And all investing involves risks, including the loss of principal. Okay. So let's set the agenda for today's discussion. What I wanted to do today, let's start off with just an example trade scenario. So we're gonna set the stage by putting ourselves in the shoes of a hypothetical options trader out there who's about to place a bull call spread trade. But they want to know for themselves what the mathematical probabilities are for success or failure of just breaking even on this trade. Then we're going to acquaint ourselves with the tools available on the thinkorswim desktop platform that might assist in that effort. And we're just going to get some repetition with those tools. I'll try to explain each as we go, but there are 6 tools that we're going to be exploring today. So let's go right to the thinkorswim desktop platform. And here's our example trade scenario. Let's say that we are an option trader who uses charts in the planning of options trades. And as we look at the charts here on thinkorswim, we might notice with ABV, symbol ABBV, that the stock had struggled to get above about that $215 level all the way through the last 12 months. There's a pretty prominent touch point right here. Back in March, we got right up to around that level again, about the first week of September, and then finally popped up and through. And for some traders, when we push up through what appears to be an important price ceiling, that may act as a new price floor. And possibly this is a sign the stock is going to be behaving more bullishly in the future. So let's say that our trader thinks, yeah, the stock likely to go up. Let's put together an option trade that might benefit from that. So here's the trade scenario. Let's say that our trader is recognizing the ceiling, that previous ceiling of 215 may be the new price floor. So they're going to structure a trade that benefits as long as we stay not just above 215, but even just above 210. Getting a little bit more cautious, going for a little bit stronger, at least conceptual, stronger probability. So for this scenario, we're going to buy a 200 strike call with the expiration of October 17th. And at the same time, we're going to sell the $210 call for October 17th. So this gives the trader the right to buy shares for 200 They have the obligation to sell those same shares for 210. So if both of these contracts expire in the money, if they're both, if ours is exercised and the short option is assigned, buying the shares for 200, sell for 210, that would be a $10 profit if this were a free trade. It's not a free trade. It's probably going to cost about $9 to set this trade up. But in any case, this trade works out optimally well. It's in the best position to do that if the stock is above 210 on October 17th. I wonder what the chances are that that'll happen. It works out, it encounters its loss potential. It's in its worst situation if it's below $200 on October 17th. I wonder what the chances are of that happening. And then something else might happen in between the 200 and 210 levels. In that case, the long option might get assigned. We buy some shares, but the short option expires worthless. We wind up owning some shares that we never set out to own in the first place. So what are the odds of ownership at expiration? That's another good question. So let's go look at each of those scenarios. And the first thing that we're going to do, I think a lot of the veteran traders here in our audience today have already moved mentally to this first step. If I were to go to the option chain, let's go to the trade tab. Let's look down here at 17th of October. Let's open that up so that we can see the two strikes that we're discussing, buying the 200, selling the 210. What is a column that I might add to the default column set here that might give the trader some insight into the likelihood of success or failure on this trade? There's one column that a lot of you probably already have loaded on your chain here, but let's add it. Let's pop up here to where it says volume and open interest, and I'm going to customize this column set to use a Greek known as delta. Let's add that to our chart. I'm just going to click add. Let's click OK. So now we see this column here right next to our bid price and our ask price. It's our delta. Now, delta can have a couple of important implications for an options trader. It can tell how much the option may make or lose as the stock rises or falls $1. So, for example, if I look at this $200 call that we're planning on buying, it has a delta of 89, which means if the stock were to rise $1, the stock might make 89 cents. If the stock falls $1, it might lose 89 cents. That's one potential example of how delta might be used. But delta also has potentially important implications regarding probability. Another common interpretation of delta is the probability that a contract will expire at least a penny in the money. In other words, at least that the stock will be at least a penny above the strike price. So if we look at the 200 strike price, it has a delta of 89. If we look at the 210, it has a delta of 79. And that's the one that I want to focus on. Mary Burns has done some math on this, and I'm not going to go too deeply in the weeds into the math of the trade itself, like Mary's done a little analysis of the risk return on risk. This is a low return trade. I'll say this much. It's a low return trade, but with a high probability of success. That's a typical trade-off with spread trading. In my experience, it's always been the trade-off with spread trading, but I can't use the term always because there may be out there some weird quirk in the options trading universe where there's an exception. But yeah, when a trader is looking for a very high probability of success with it, which this trade actually delivers, there tends to be a lower reward potential. So let's talk about that probability of success. With this trade, you may have noted on our chart, the trader would just prefer to be above 210. So I've drawn in a green box up there to indicate that's where we'd like to be. Where we would not like to be is down here below 200. Okay. So what are the odds that we might be above 210? Well, when we have a delta of 79, another way to state that is there's approximately a 79% mathematical probability that if we just put this trade on, duck our heads in the sand, and let it go all the way to the October 17th expiration, there's about a 79% chance that the stock will be above 210. That contract expires in the money, and the trader's in good position for the maximum theoretical gain on this trade. All right, 79% probability. I don't know, where would you place that on the scale of high to low probability? I think an argument could be made that's quite a high probability. Now, when we hit those very high probabilities, yep, the reward potential goes down. What we would all love to see is a very high probability of success associated with a very high reward potential. 99% probability of success with 300% return potential, that'd be awesome. Doesn't exist. Wish somebody could show me that. Yeah, so Mary Burns, you've raised that good point. This is a trade. If we look at the cost of the setup of this trade, it's not going to be high reward. I actually mentioned that a little bit earlier in the webcast when I said it might cost us $9 to set up this $10 trade. Anyway, so that's our probability of expiring in the money, is the way that delta might be interpreted. Well, that can tell us the probability of success if we look at the upper strike. It can also tell the trader the mathematical probability of failure by looking at the lower strike. Because what we'd like to do is see both of these contracts expire in the money. So there's an 80% chance of exactly that happening. If you notice, there's a 90% chance of at least the lower strike expiring in the money, which means there's only what's left over. 100% minus 90% means there's only 10% chance that we might wind up down here below $200, where both contracts are out of the money and we lose our entire investment at expiration. Only a 10% probability of that happening. 80% probability of success, 10% probability of failure. And if you're doing the math correctly, you're probably saying, wait a second, Cameron, 80% plus 10% is 90%. We're missing 10% here. Yep. There's 80% of maximum gain, 80% probability of maximum gain at expiration. There's a 10% probability of maximum loss. And then there's a leftover 10% of something else happening here. Maybe making a little bit, maybe losing a little bit. Not maximum gain, not maximum loss, but falling in between our strikes. So we might look at that as being the probability of having some success, but not maximum success, or having some failure, but not maximum failure. Another way that I look at this, though, is if we land in between these strikes, let's say the stock is at 205 at expiration. So it's not above 210, not maximum gain, not below 200, not maximum loss. If it's at 205 and we have the right to buy shares for 200 according to our contract, do you think this trader is going to do it? Yeah, they buy the shares. Great. Shares are worth 205. We bought them for 200. If we're waiting for someone else to buy those shares from us, we're going to be disappointed in almost every scenario because nobody wants to pay 210 for shares that are only worth 205. So the trader might wind up owning shares at expiration. If they allow this contract to go all the way to expiration, if it's below 210 but above 200, they're going to wind up just owning shares. So there's about a 10% probability of that. So that's very interesting. And this is a tool that can help to lay out those probabilities. However, I will say, Eva's got to run. All right, Eva, we'll see you next time. Thanks for watching. So routinely, definitely appreciate that. But Delta was not purpose-built for calculating probabilities. It actually does a fairly serviceable job. It's only off by a couple of percentage points for a tool that actually was built for that purpose. So let's do that. Let's get a tool that's actually built for calculating these probabilities. Not at all to disparage Delta. It's used very commonly by traders because what we're talking about here are probabilities, likelihoods. They may work, they may not. Nobody knows exactly what the future holds, but we can come up with pretty strong probabilities of things happening. So I'm going to use a second column that's actually purpose-built and specifically, let's say that our trader wants to know what's a closer probability of a contract expiring in the money. Well, actually, thinkorswim has a column available called probability in the money. So let's pop up here to our list of default columns now. We've added Delta. Let's customize that column set again, and I'm going to type in probability, and we're going to choose in the money. Let's add that, click OK. And so now this is going to have some overlap. One thing that I'm going to say is going to be a common thread through all of the tools that we're discussing. They're all really built to gauge probabilities. There is going to be a lot of overlap and redundancy. Not every trader needs to know every tool or use every tool in the analysis of every trade. So maybe if we just know one or two, we might just use those to assess the probability. So probability in the money is specifically an algorithm that is purpose-built to calculate the mathematical probability of a contract expiring in the money. So you will notice a slight disparity between these two. You'll notice they're very similar, percentage point or two off here or there. But probability in the money tells us the likelihood of expiring in the money. So the 210, we might look at that again and see it looks like, right, rather than a slightly more optimistic 81% probability of success, this one actually stands maybe more accurately a 79% probability of success. Now, I hesitate to use the word accurately because we're talking about a probability here. Is it accurate to say that there's also a 21% probability that we don't have maximum gain? Yep, that's also a possible outcome. It's not as likely, but it's certainly possible. Okay, so yeah, a trader might look at this and say there's a 79, 78. Notice these are real-time numbers. The markets are moving. As the stock price moves, either further away from our spread and making it more likely that we're going to be successful, or closer to our spread and making it less likely that we're going to be successful, these probabilities update in real time. So we know at the moment the trade is placed what those probabilities are. So right now we're back to about 79% probability of expiring in the money, and these contracts realizing their maximum gain. Now for other traders though, typically when we are doing a long spread trade or a long option trade, the primary concern of the trader is whether or not the trade is going to be in the money, or among the primary concerns is whether we're going to be in the money. When we are selling contracts, let's say credit spreads, maybe the trader's concern is actually whether the contract expires out of the money. Now they could work this backward. We could just say, well, if there's a 77.65% chance that we're going to be in the money, well, that would leave our 22.35% chance that we're going to be out of the money. That's true. Or guess what? There's a tool for that. Let's pop up here to our layout again. Let's further customize our column set. Let's start typing in the word probability again. And let's add that to our list of columns. So now we have, it's starting to get a little bit cluttered. You'll forgive me, I'm going to drop delta out of this. But you'll notice here as we hover over this, we can see which one is probability in the money and which one's probability out of the money. Let's pop up here again. Customize this column set. Let's just remove that delta for now. There we go. That way we can just focus on probability in the money versus probability out of the money. So we can look at those two strikes again. We can see there's about a 77% probability of in the money. You'll notice these are precise complements to one another as they update in real time. Added together, those are always going to add up to 100%. So just to revisit the concept here, though, if we have a 75% probability of expiring in the money for the 210 strike, and about a 12% probability of expiring out of the money on the 200 strike, add those two together, we're up over, we're getting close to about 90%. Remember, the difference there is the 10% probability that we wind up somewhere in the middle. So each of these can really, as a trader is gauging, maybe I do want to go back to that question, or back to that observation that, who was it that made this observation? I like to give credit where credit is due. Mary Burns. Mary Burns said, this is not a very high return on risk trade. Let me show you what she was talking about. If I were to go up here to our spread where it says single, let's just pair these two together for just a moment. Let's change that to a vertical. So now we can see the 200 has been paired up with the 210. And if we look at the net cost of this vertical spread that we're considering, somewhere between 865 and 955, split the difference is about a $9 trade. So it's it's costing us $9 to set up a trade where if it goes perfectly, we wind up buying the shares at 200, selling them at 210. That's a $10 value. So turning $9 into $10 is it's about 11% return potential. Okay. A $1 reward on a $9 investment. Well, for some traders, they may prefer higher reward potential, a higher percentage potential, but understanding how much we can make, $1, how much we can lose, $9, and the probabilities of either one of those scenarios can help the trader make more informed decisions. There's roughly an 80% chance that we're going to make the dollar, roughly a 10% chance that we're going to lose the 9, and roughly a 10% chance that we wind up somewhere in the middle. And we know all of that just by using these columns. All right. So let's switch this back. Let's go back to our single, because I did want to look at one more column here, and I want to throw out a hypothetical. Let's say that our trader likes this scenario. Okay, I can make 11%, and there's an 80% chance that I'm going to make that. Awesome. Let's say they're going to do that, but they really don't want to lose their $9. They recognize that when we place a trade like this, we might lose the full value. So instead, they strike on an idea. Let's say that the trader plans, here's where the stock is now. It's well into the profit territory. As long as we stay up here, we should be in good position to make the maximum return on this trade. What if we pull down, though? Let's say that our trader says, you know what? If this stock so much as touches my spread, if it pulls down and it touches 210, I'm out of here. Now, that might happen on day 1. It might happen on day 15. Who knows? But if it comes down, touches that 210, we're not even going to give it a chance to get down to 200 unless there's a massive gap. Well, that changes the probabilities of this trade. Let's see how much it changes those probabilities. And this, in order to see this, I need another tool to give me some insight here. I wonder what the odds are, because probability of in the money, probability of out of the money, and delta are all assuming we let the trade get to expiration. There is a 77% chance that we'll be in the money at expiration at the 210 strike. There's a 23% chance that we'll be out of the money on that to 210 strike at expiration. What's the chance, though, that the stock goes down and touches that level at some point? I'm going to come up here one more time, go up here to where we've loaded up those custom study sets. Let's customize that column set one more time, and I'm going to type in probability again. Seems to be a theme here, probability, probability, probability. We're going to explore something called the probability of touching. So let's click OK. So you'll notice now we have this column that's called probability of touching, abbreviation to prob touch, abbreviated to prob touch. If we look at that 210 strike, where this trader has the idea in their mind, I'm pulling the plug on this. If this stock even touches 210, guess what? There's about a 47% chance of precisely that happening. Now, that doesn't mean that there's a 47% chance that we're below 210 at expiration. This is just touching 210 at some point before expiration. So it could be that we come down here, touch 210, and then reverse and go right back up again, and we're just fine on that trade. But if the trader jumps right there, if they pull a plug on that trade, very likely they lost money. Here's how that changes this trade scenario. We just went from a trade that on day 1 had an 80% probability of maximum gain, and now we've introduced a 47% probability. Nope, we're going to be getting out before that maximum gain even has a chance, and we incur some amount of loss, most likely. So yeah, we've dramatically changed this from only a 20% chance of coming up short of maximum gain to about a 47% chance. That's how much having those plans, yeah, we're trying to mitigate loss, but it also introduces additional percentage risk here. All right. So that probability of touching, I think, can have some important implications for traders. Those are 3 tools, actually 4 tools: delta, probability in the money, probability out of the money, probability of touching, that are available right here on the option chain. But each of these share a bit of a shortcoming, and that is they're only available for the price levels of the strike prices. So we can know the probability of something being in the money at the 200 level, but not at 201 or 202 or 203 or 207.50. I think you get what I'm talking about. There are big gaps in our understanding of probabilities here. And there's another tool that can fill in those gaps very nicely, and it's called, if we pop up here to the Analyze tab, the risk profile. So I'm going to be analyzing the probabilities of this trade with some additional precision here. But the first thing I'm going to do is load it into the thinkorswim platform. So I'm going to go to the Analyze tab, and we're going to add a simulated trade. So let's go out here to the 17th of October. Let's change our spread to vertical, and let's go down to our 200-210 spread. And I'm just going to click on that ask price, and let's lock that in. Look at that. Looks like it might cost us right about $9 to do this trade. So what we're doing here is creating an example limit order, saying, okay, we're willing to spend the $9 it takes to get into this trade. And how about for this one? Let's just do one contract, just to keep the math nice and clean and simple. But once we've loaded this in on our Add Simulated Trade tool, we can then pop up to the Risk Profile tool. And this is now giving us a profit and loss chart of this trade. And it also provides us important probabilities associated with that trade. First thing I'm going to do here, let's reposition this a little bit. I'm going to show you a nifty little feature of the tool. Right up here in the upper left. By the way, you can see our profit and loss chart here. And I'm going to be focusing on this gold line or this yellow line. This is showing us an intersection of loss at $200, gain at $200 or above, and that's intersected with an assumption that we've gotten to expiration, right? But it's kind of pushed over to the left side of the chart. That's because we've put this trade on so far below the current price. The current price right now is at 221.22. Our trade scenario that we've set up is well below that. So I'm going to drag this over. Okay. I don't know if you're aware of that. Let's just drag that over a little bit. Let's just set it right there. It's a little bit more centered. I don't like this little squiggly line that we're getting right there. Let me show you how to get rid of that. I'm going to click on the little button, the little uncheck down here, and let's put it back on there again. Just makes it smoother. Anyway, so this profit or loss chart is basically telling us, hey, at expiration, Cameron, if your stock is at or above $200, we'll be in position for our maximum gain, which is about $1 or $100. If I put my cursor up here at 214-ish, and I look down there at the lower left-hand corner, I can see that's projecting about a $100 profit. Below $200, it would be projecting a $900 loss. Ooh, ouch, that's intimidating. Well, let's see what the probabilities are of either of those scenarios happening. And the way to view those probabilities very plainly is a combination of two of the tools right here on the Analyze tab. First thing are these slices. So these slices, we call them slices, they're kind of slicing up the chart into 4 quadrants, starting with the current price of 221.32. That's just where AbbVie is trading right now. And then over to the right is 10% above that price. Over the left is 10% below that price. thinkorswim doesn't know exactly what the trader wants to see regarding their probabilities, so it just puts the 3 slices on there by default. Current price, 10% above, 10% below. But those can actually be manipulated. And as we do that, I'm going to keep our eye on the probability numbers up here, and I'll explain what those mean. Now, before I change those lines, I'm going to come up here and change our date. This is a 17th of October example trade. And as of the recording of this session, this webcast, it's actually the 17th of September. So I'm going to change this out to the 17th of October. And what you'll now see is there are some percentage numbers here. These are actually probabilities. But probabilities of what? Well, let's click and drag this first line over to $200. So as I position that as closely as I can, there it is, right at $200. This is now telling us about a 7.4% chance that as of October 17th, the stock will be below $200. Let's do something else here. you'll notice there's a red line here intersecting with 0. That represents 0 profit on this trade. What are the chances that we at least break even on the trade? Let me click on this line and drag it over to the break-even point, which is at 209. And it looks like there's about a 71% chance that we at least break even on this trade. Now, actually, that's not entirely accurate, because if I were to look over here, it's actually 71% chance that we're above 209, but falling short of 243. 243 is just 10% above the current price of stock. Let's make this a more meaningful slice. I'm going to click on that and drag that over to 210. And you'll notice that our percentages are adjusting as I do that. So what we're ultimately left with is we put our lines at 200, break even, and 210. We can now see there's about a 7.4% chance that that the stock winds up below $200 at expiration, and we're at maximum loss. Not much of a chance. Yep, that's pretty much in keeping with the probabilities that we saw earlier. Prices have changed since then, so a little bit different than the probabilities that we saw earlier. Now there's about a 77% chance that the stock is above 210 at expiration, and there's about a 13.6% chance that we're somewhere above 200, below 210. That's in that scenario where we're not making our maximum gain, we're not making our maximum loss, but we may be in position where we wind up buying the shares and no one buys them from us, and we just own the shares. So I might also look at that as the probability of ownership of stock at expiration. All right. Now, one thing that's missing here, just because it's so small, there is a small probability that we wind up somewhere below break even and just short of our maximum gain. So not losing money, but not making the full dollar potential of the trade. So pretty powerful tool there. This is known as the risk profile tool. If you're not familiar with it, I've done videos on this tool in the past, very recently. Matter of fact, if you were to go to the channel, by the way, do yourselves a favor. If you're watching for the first time and you haven't subscribed to the channel, make sure that you're subscribed to our YouTube channel. It's called Trader Talk Schwab Coaching Webcasts. This is where we house our webcasts once they've been completed. So you can find those under playlists right here. So for example, you could go to the playlists on YouTube. You can scroll right on down to the bottom to find my playlist for getting started with thinkorswim, and just click right there. So this way you can see, like, for example, last week we talked about the newest tools and features that had just been added to thinkorswim. Or if you're on the channel, you can also do a quick search. Here, let's type in risk profile. Let's find a webcast that focuses just on that risk profile tool, because I gave a brief introduction to it. Here's a more in-depth examination of that tool. Let's learn thinkorswim's powerful risk profile tool. Okay. Now, of course, you can also join the live streams here. So yeah, definitely make sure that you're subscribed to our channel if you haven't done that yet. But going back to thinkorswim, a final tool that the trader might use. So we've acquainted ourselves with 5 tools now. And I think you're already seeing there are a lot of these with overlap. Some of them have, some of them are perfectly serviceable for what they are. Other, traders might have a preference for one versus the other. For example, maybe they prefer more precision at more specific price points on the stock chart. These slices can be used very precisely, by the penny. You can just move them up and down like this, and it changes those probabilities. Can't do that with delta, probability in the money, probability out of the money, or probability of touching. But there's a final tool that I'm going to introduce you to, that for some traders, they just want it to be quick. All right, this tool can be used very quickly. It's also found on the Analyze tab, and it's known as the Probability Analysis tool. You just click on that. All we have to do to enable this tool here is to make sure that we have our symbol up here in the upper right, or in the upper left. So I'm going to type in our symbol for ABV. And what this tool does is it intersects price levels, starting with the current price. So right now we're just slightly above 220. and time increments. So starting from day 0, that's today, and moving out in 10-day increments. 10 days from now, 20 days from now, 30 days from now. What you'll also notice is that there are apparently slices, but in this case these are just expirations for the contracts available on AbbVie. So if we were looking at, let's say, the 17th of October expirations, that's the contracts that we were placing a trade for right down here, we could go right to 17th of October and just move our cursor up to our strikes. Let's see, we had the 210 and the 200. So I could just position my cursor right there on the 17th of October at, let's say, 200, and it gives us the probabilities that we will be above or below that price level on that date. So you'll notice as I take my hands off my cursor, about an 8% chance we're below 200, about a 92% chance we're above 200 expiration. So that's about an 8% chance of maximum loss, being in a maximum loss scenario on this trade. Or if I just move up to 210, let's just move up there. Let's get as close as we can. There we go. There we go, 210.05, close enough. These are all estimates anyway. 77% chance that we're above 210 on the 17th of October, 23% chance that we're below. So it's a very, in my view, a very straightforward tool to use. All we did was typed in the symbol, and then we just start moving our crosshairs around on the tool. No other customization required. Now, I think I'd be a little bit remiss if I didn't address what in the world is this thing, this bullet-shaped thing. Looks like a comet streaking to the left. This is known as a probability cone or parabola. What is it? Well, this starts from today and then expands outward to try to capture a range of prices that deliver a 68% probability that the stock will fall within that range on a specific date. So if we're trying to get a 68% probability, it's only a couple of days away. We don't have to go very high above the current price or very low below the current price to capture a 68% probability, or in other words, a 1 standard deviation probability of the stock falling in that range. On the other hand, if we give the stock, let's say, 70 days to move, let's go through for about 65 days, 21st of November. Well, if we're trying to guesstimate where this stock is going to be on the 21st of November, 65 days from now, and we want a 68% probability of being right, we're going to have to widen that range. So for the mathematicians in the audience who use standard deviations in their approach to whatever, that probability cone might be useful, but really don't even need to look at it to establish probabilities that we're above or below certain levels on certain dates in the future. Just intersect time with price using the crosshairs. All right, so guys, we've accomplished everything that I set out to do today. We got, I think, a pretty in-depth introduction to 6 probability-related tools that might assist a trader when they're planning. They have a concept of a trade, and they want to know, what are the chances that my stock's going to be above a certain price or below a certain price on some time in the future. Each of these tools might provide some important guidance in addressing that sort of a question. So hopefully this has been helpful for you. This is what we do when we're getting started with thinkorswim. I like to acquaint you with tools. Sometimes it's just using a theme like probability. You're invited to join me again next week. We'll explore some other functionalities of the tool or of the thinkorswim platform. But you're also certainly invited to join me in my other webcasts. I have a new webcast every day of the week on a range of topics. Some are platform-oriented, some are strategy-oriented, like options trading. So you're certainly invited to join me in those other webcasts. I do want to suggest a couple of things as I turn you loose to go enjoy the rest of our educational offerings for the rest of the day. Just make sure that you are taking full advantage of the entire range of educational offerings that are made available to you by Schwab. Number one, of course, is to make sure that you're subscribed to our channel. So if you haven't done it yet, go down and click on that subscribe button. You can find it in the lower right-hand corner or just down below the video stream. So this is where you can join the live streams, view our playlists, do searches through our archives. Also, make sure that you're following Kevin and me on X. You can follow Kevin there at Kevin Horner CS. You can find and follow me on X at Cameron May CS. So, for example, well, this really is just the best place to connect with us in between the live streams. It's where I can publish things when the camera's not on, and I can communicate with my followers there. So, for example, just this morning, I just published a video that proposed this observation. Hey, are your charts actually reflecting the full value of your dividend stock investments? There's a tool on thinkorswim that may be eye-opening, and I spent just 2 minutes introducing that tool. So people reply to me on these posts. I try to reply right back to them. Great place to connect with us. So guys, love to have you there as a follower. Go enjoy the rest of our educational offerings. Thank you to everybody who has already clicked the thumbs up or the like button on YouTube. I can see still 80 people watching. 33 have clicked the like button. That's always appreciated. If you watch one of our webcasts and you enjoyed it, just click thumbs up. It's like a pat on the back to your presenter. It also gives that presenter's webcast a boost in the YouTube algorithm and helps more people find these videos. Helps more people learn about tools, about things like tools for assessing probabilities. All right, everybody. I'll see you in another video. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.